Hey everybody, this is Paul making a quick video. Just do some year-end performance reviews of my portfolio, how I did for the year, and then just kind of how December's been going and just kind of my plans going into 2022. So as it stands right now, as of like literally today, we're in sort of a Santa Claus rally. The market is very low volume right now, so moves can be exaggerated to the upside and the downside with very little amount of just volume. But right now, it's in an upside trend. That it started when the consumer numbers came in, so that's when it's kind of like backed off because it sold off on Monday, but that's expected just for very low volume. And then just more different Omicron news coming in. So what do we got right now? So right now I'm at 59, 760 or 793. The month of December has been pretty amazing, actually. So as it stands right now, I'm up. I've made $4,041.65, which is the 6% return, and a little bit of money I took, just say profits, and then just a little bit of money out of my paychecks and whatnot. But majority of this money is just profits from the market that I've taken from just selling some things. I'll show you what I sold. So right now, as it stands, this is where it's at. What do I expect for the rest of the month? Pretty simple. There's not much that can go on before the end of the year. So what you could see is just the market's closed tomorrow, and I think it closes early today. So like say you'll see a rally going into the weekend. Actually, this might sell off a little bit going into the weekend. And then on Monday, depending on what kind of Omicron news you get over the weekend or like anything, but I don't expect much. But you might see like maybe like a little bit of a sell off on Monday and then like a little bit of a rally, a little bit. It's going to trade flat. And the reason why is because this is currently still the current tax year also. So, and then also it's just low volume, just very low volume. So if you get a lot of selling pressure, it won't take very much to bring down the market. If you get a lot of buying pressure, it won't take very much to rise the market. So that's where we're at right now. But the real trading is going to start after the first on the third. So this is when the new year picks up right here. This is when you get back into this is when you start to get back into like earnings season and whatnot. And this is where so for 2022, just the current plan is to stay where I'm at. And the reason why I'm going to stay where I'm at is because of the Fed. There's no reason to move into anything else. Um, right now, rates are up, which would typically mean the NASDAQ would be down, but the NASDAQ has sold off a lot. But like I said, it doesn't take much to drive this up right now. So rates are still going up. The curve is flatter, but it hasn't inverted. We're going to get more Fed news. I expect rates to go up. That's kind of my prediction for rates for 2022 is the rates. So the Fed should be done tapering. When the Fed actually tapers, which means that they, cut their bond purchases in half, January, February, March, that kind of area, that's when the market's going to be kind of, I think like there's going to be like more of a shift in the market. I think the Nasdaq's probably going to take a big hit around that time. And it could be priced in, but I seriously doubt it's priced in. But one other thing that could happen is you could see people get out of more into parts of the Nasdaq where they're actually making money, which is the big five, Nasdaq or like Apple, Microsoft, Facebook, those type of things. One thing I have noticed in the month of December is without a doubt, so right here for performance for December. So you had this drop here. This was like the Omicron news that pretty much tanked the market. Um, and then as the Omicron news kind of filtered through, we got more information. I said, okay, the current vaccines do work as long as you get them at preventing you from getting hospitalized and dying from it. And then what happened is right in between there, so you get a little bit of a rally, and then also you get the Fed coming out with their information, and what that does. So you can look at my portfolio, the purple one there. It goes from 14.48%, jumps to 17, and then as the market kind of dips on Omicron news, so this is like that reopening trade, like especially with the UK and whatnot, which I don't have any exposure to. You can see my portfolio rode out that news much, much better than the rest of the market. So you see like it dips, there's this dip, but mine didn't really dip at all. So what I did is I wrote it out. So basically I've gone from up 14.48% at the beginning of the month to now being up 19.65%. So that this month's going to be, or this year's probably going to be around 20% if this trend continues, which is pretty good. Because I didn't come close to outperforming the NASDAQ last year. That was just the place to be last year. But so that's year to date, 19.55%. Started the year with 43,000. Now I'm at 56,000. Probably will be around 57,000, give or take a little. As it stands, dividends per year, 24.54. There's a lot of things. QYLD actually changed when they do their payouts. It used to be at the end of the month. Now it's at the beginning of the month. So that's one thing, which better aligns because they're actually their monthly thing. So it never made sense that they paid out at the end of the month. It always would make sense that they pay out at the beginning of the month when they rebalance their holdings. That's literally how that works. But so that's how that works. So for January, expecting roughly 233 in dividends. Trying to bolster up March because I pulled back. So what I did is going into December, I pulled this QYLD position back a significant amount. If you notice, this used to be maybe about 7,000, but as soon as the Fed said they were raising rates, that was a big red flag to me to pull out of QYLD. So that's why it actually, if you notice here, I was at 28.22 for dividends, and now I'm at 26. That would be why. If I ever wanted to bolster my portfolio, I would just dump it all into QYLD and get like 500 a month or whatever. But it would just move sideways. It wouldn't really move up at all. But with the Fed saying that they were going to raise rates, and as you can see, rates responded as such. You can see these rate moves right here. The NASDAQ took a big hit. The NASDAQ took a really big hit. If you go to the 1 year, so you can kind of see like it was trading up as the Omicron news came out, and then the Fed was like boom, boom, it's just taking hits. Don't know where it's going to go. I don't know much about the NASDAQ. All I know is that my only exposure is QYLD, so that was a very easy way to pull back on exposure to the NASDAQ and redistribute it into dividend stocks, which just completely took off. Just took off in the month of December. I expect that to continue as people are effectively forced to move into companies that have profits. You just don't have a choice. As the borrowing rate goes up, the companies that rely on debt are going to have to finance that debt. Well, they're going to have to finance that debt at higher rates. Right now, these rates are kind of a joke, but bad companies, these rates are a big deal to them. Good companies, these rates don't really mean anything, like Coke, like, just your dividend value stocks. So good companies doesn't mean anything. Might mean something to AT&T, but AT&T actually just got upgraded. So might actually go up to 28, give or take a little, but we'll have to see what happens with AT&T. So one thing I did get rid of was Pfizer. The only reason that I got rid of Pfizer, and I can show you why, is Pfizer used to have basically like a 4% dividend payout. Their most recent dividend increase was really, really super low. They also got up to about $60 a share. I think I had made, when I sold Pfizer, I can actually show you how much I made on that Pfizer trade. But when I sold Pfizer, I basically made 3 years worth of dividends off of it. It's around here somewhere. So $314 is what I made off of Pfizer when I sold the entire position. It's as it stands right now, it's just a very low yielding stock in a portfolio that I'm trying to keep around the 4.4% mark for dividend returns. If it ever drops, it could drop going into the new year. I'm not sure. Normally you wouldn't sell a stock like this, especially if you bought it at such a low price. The problem with the stock though is that it could go back down again. So it's one of those stocks that's starting to trade around Omicron news, and you can kind of see, or like around coronavirus news. So you can kind of see it's just, it does this. It's like a 30-something dollar stock, and then they just, the U.S. government buys a bunch of stuff for Delta right here. And then Delta starts to fade off, and you see what the stock price does. So like, went up to 48, and then it dropped, right, to 41. So if you bought right here thinking it was going to go up here, now all of a sudden, you took a huge hit. But then all of a sudden you get Omicron, now all of a sudden look what it does. So everybody's getting boosters now. A lot of their profits, even though they do have profits from other drugs, a lot of their profits are currently being driven by the coronavirus. It's very coronavirus heavy exposure. So even though it is, a low PE stock, it's kind of like Moderna. So like Moderna is kind of in a very similar situation. So like Moderna, a very, very large amount of their money comes from like basically coronavirus, boosters, injections, that kind of thing. But once Omicron falls, are we going to see another one of these? But a much sharper drop, as you can see right here. Are we going to see a much sharper drop? Because now the stock rose on Omicron news in here, in the booster, needing the booster for Omicron, but then it also rose again because of the pill. So, and also bad news for Moderna about their heart inflammation rate. So now, if Omicron drops off all of a sudden, which is expected, because that's kind of what happened in South Africa, it burned through the unvaccinated population very quickly there, and then it dropped off significant. Are you just going to see a straight line down? I'll touch Pfizer again if it gets to around. I'll see what the analysts are saying, but analysts are saying it should be a $56 stock. But see, there's 51 in here. This was just, if you look here, the 22nd. This is a professional analyst at Goldman Sachs saying it should only be a $51 stock. So if it gets to around 51, I'll buy back into it because they do have a pipeline of like other drugs and whatnot that are not coronavirus related, where they'll do good. But something like, mRNA, you can check this yourself. It's a really high thing going on right here. It looks really good. But, if they do really good into these waves, but if you look at it right here, if all of a sudden, we go into next year and all of a sudden, coronavirus just drops off the map, this stock could literally get cut in half. There's a lot of people that are going to get burned on this stock, I expect. It just effectively relies on bad news because they're a one product company. And unless they come up with something else very soon, they're gonna have trouble in 2022, I expect, because Omicron's just burning through the population right now. Like it's really burning through the population right now, big time. So either you're gonna get a booster or you're gonna get a shot. So you can kind of see, like this was a $419 stock, got cut completely in half after Delta, and now it's kind of maintaining a little bit, but you can kind of tell where this is going. So that's why I'm kind of cutting my exposure to Pfizer and I've never touched Moderna in the first place. But, so what's my plan for 2022? Effectively to stay where I'm at. I think as the Fed starts to taper and they start talking about rate increases, especially around March. March is when they're supposed to be done tapering. That's the expectation. When they start talking about raising rates, that's when you're going to see, kind of see like the market get kind of like antsy. I think earnings reports that are coming out in the first quarter are going to show just blowout numbers for the fourth quarter. Like consumers very healthy. You can see this yourself. You go to the mall, you go anywhere. got to kind of see what Washington does. Do they extend the child care tax credit? Because as you can see on my own personal little thing that I have here, I'm leaving this area blank. Filled in all this, but this area is being left completely blank. So will that be an extra boost into people's pockets, or will they cut those payments and then all of a sudden a bunch of people realize, oh, there's inflation, and then the Fed's raising rates at the same time? So you could see a slowdown in 2022. I'm expecting a slowdown in 2023 because of, even this a majority of this market can't handle higher rates. It just can't, and you can kind of see. Right now we're at 0.68%. Go out to the 5-year. You can kind of see right here. It didn't take much on the 2-year. I expect the 2-year to be trading around maybe 1.75% by the end of 2022. When it got to 2.92%, people were talking about Armageddon in the market, companies starting to fail. Like, if the Fed kept raising rates. And you can see when the Fed starts raising rates, this is very clearly what happens. It started at 1.26%. And you can actually compare this to the market. If you put these two charts next to each other, right around September is when the market peaked, and then it just straight up dropped. It started to drop, and it didn't start to go back up until they started dropping rates, and then the market just, the two lines are basically parallel to each other, or not parallel, like inverse of each other. As this one was going up, the market was going down like that. And it happens very quick. It happens very, very quick. As soon as they start raising rates, boom, you get to hear very quick. Because they will price in, by the time the Fed's talking about pricing in like their second or third rate hike in 2022, the market's already pricing in the rate hikes for 2023. So that's how you get from there to there very quick. So we will have to see where it goes from there. But the place to be is value stocks, companies that have profits, have money, have a good balance sheet, and you should be safe, I would think, going into 2022. The Fed could always come back and say, no, we're cutting rates because something happened, but the chance that rates go up more than they go down to control inflation and do like the Fed wants to press the brake pedal on the economy right now, and that's kind of what they're going to do with the rates, to slow it down, to slow down the home buying, to slow down the credit card purchases, to slow it down just a little, and that'll slow down the demand side. So they're trying to stop inflation, which is at pretty rough highs right now. So let's see how 2022 goes. I think the story of 2022 is going to be inflation and the Fed raising rates to slow it down. The chance that the Fed makes a mistake, which means that 2-year right here goes up higher than that, is very high. These two invert, there go your bank stocks. So that'll take out your entire banking sector, just doing something like that. So, but we'll have to see. Leave in the comments, whatever, in the the video thingy in the comment section there. If you have any questions, just let me know. Thank you very much. Y'all have a nice day.